welcome to Bothsides TV. I'm super excited today to have my guest that I've talked about doing the show with for almost 3 years, Jeff Clavier, the founder of SoftTech VC. Welcome.
Thank you. I'm so excited that we have found that time to finally do that show.
Yes, we've been talking about it for a while, and I've taken a short hiatus from the show, about 4 months, because I had to do this thing in between called raising a fund.
Which, I know, right?
Yeah, which we closed and announced. It was $280 million. And we've both been on the road quite a bit, fundraising over the last 4 or 5 years. You too raised a new fund. When was your last fund closed?
Last fund closed last year, so
okay.
2014 was a big year for us. So we celebrated the 150th investment, the 10-year anniversary of SoftTech, the close of the $85 million Fund 4, and the move of the main office to San Francisco.
I was at your 10-year anniversary party. It was fun. But what I want to do is rewind.
Okay.
What many people probably don't know is in 2006, I was in Palo Alto. I was fundraising for my company. I was asking who funds this kind of stuff. And everybody in Palo Alto was telling me, you have to talk to this guy, Jeff Clavier. And there was no category called micro VC. There were no seed funds. And if I understand correctly, from about 2004, you had your first fund, which was mostly your own money. Is that right?
Which was only my money. Fund 1, I mean, we called it Fund 1, even though it was just my angel investments, which were about 24 companies that I self-funded out of, our savings.
But what made you decide to do that professionally and be crazy like that?
So essentially, let's rewind even a bit more. So I was an entrepreneur. I did a startup in the financial services market, brought Sun workstations and trading floors in the late 80s. Company was acquired by Reuters in 1993.
And it sounds like that's not a New York accent that you have.
No, I was born in Paris, Texas.
Okay.
I was born in Tours in the Loire Valley.
Yeah.
After the company was acquired, I stayed with the acquirer, Reuters, for a bunch of years. I was one of their main sort of tech guys. And in 2000, after going through the Euro transition, the millennium, and putting in place the 35-hour week in my shop in France,
which was a legal requirement of the government.
Which was a legal requirement where you could be not really sued, but fined if ever you were caught working more than 35 hours per week. Which disgusted me from ever working for anything French ever again.
Can I stop just to tell one quick story? I got to meet the French finance minister in the year 2000, about when it was implemented, and it was a group of us, and we said, how on earth could you support the idea of a 35-hour work week? And he said, I love the 35-hour work week. I'm like, you're the finance minister, and you seriously love the 35-hour work week? He said, you know what? I love it so much, I do 2 every week. I thought it was a good line.
Yeah, the problem is that we were allowed to only do 1 sort of work week. And so that really disgusted me from staying in France, and I decided to sort of leave Reuters, and by complete serendipity, I ended up having lunch with a friend of mine who was in the Reuters Greenhouse Fund.
Yes.
And he said, oh, we're opening the Paris office next week. Why don't you meet the head of the fund, John Taysom, and have tea, because he was British. So you have tea and you have beef sandwich with him.
As you do.
As you do. And
le roast beef.
Exactly. And he basically said, hey, why don't you join us and become a venture capitalist and move to Palo Alto to be our eyes and ears on the ground, because they were based in London. And so I came back and told my wife, oh, I found this VC job in Palo Alto. That's awesome. Let's pack and go. And she said, VC, you? And
a vote of confidence?
A vote of confidence. And so I spent 4 years as a partner at the Greenhouse Fund. And I saw the emergence of this new generation of companies in 2003, 2004 that were extremely capital efficient.
And you were living in Palo Alto?
I was living in Palo Alto with offices in Palo Alto.
And most of the companies at that time were Palo Alto, Mountain View, Menlo Park, Sunnyvale, Santa Clara,
San Jose for some.
Yeah. And we'll come back to that later, but that was how it was.
But I was basically, the valley.
Yeah.
And clearly there was a funding gap because entrepreneurs were looking for, 200, 300, 400K. and VCs were still in the model of funding, these companies with 5 or 10 million. And so I started to see those opportunities, and I thought this was really interesting, and I met a few entrepreneurs, and I had this crazy idea of going in, doing it on my own, for a few years and see. And my wife and I sort of agreed. So we had made a little bit of money, but not a ton of money. So we agreed to take $250K of our savings, and that I would spend a year not working, but trying to do this thing and meet entrepreneurs and spend time and figure out whether there was a there. And
but you had this cozy VC job with a big company like Reuters, and
but corporate VC is not real VC. Sorry about that to my corporate VC friends. But and it was not an early stage sort of practice. It was more sort of a Series B. And
so you wanted to do what you wanted to do.
Yeah,
and
which
in
is supporting
2004
entrepreneurs.
You started doing that.
Yep.
And so you would write back then average check size at what?
25, 50K, because it was out of a 250K pool that was going to last for, a year and a half.
And who were your co-investors in those kind of deals?
At the time, so obviously Ron Conway was still there. And Ron sort of brought a few of his friends who were not tech. They were tech investors, but they were not tech practitioners, and they were just investing on the basis of what Ron was doing. Reid Hoffman, started investing quite a bit at that time. I met Josh Koppelman when he was still investing out of his own sort of.
So like the early guys, for those who don't know, because there's now must be 80 or 100 at least seed funds, and there's
make it 150.
150, but back in the day, it was Jeff Clavier on his personal dollar. It was Josh Koppelman originally, mostly on his personal dollar.
And then introducing the vintage funds for first round, yes.
And then Phil Black, mostly on his own dollar, from my memory. He had either his own money or a small fund, and that eventually he teamed up with John Callahan to create True Ventures. Yes. Who else? There's almost nobody else.
2004. So I don't remember when Maple sort of came, but I think it's around that
Maples.
time. And who else? There were essentially about 10, 12, 20 sort of angels who were coming and going and participating to those rounds. And believe it or not, it was actually hard to put together a 250K or 300K round because it took a bunch of 25K checks. And at the time, every now and then I would write, the first check for a company, and I would be sort of the only investor, hoping that I would be able to convince other people, because you're really lonely when you put 25K in a company and that's it, right? Yeah. And so, we did that a few times, and I think I was lucky to have a few companies that were A, good, B, that made it sort of pretty quickly to the next round or got acquired sort of quickly. Truvio, which was one of my first real sort of outcomes, I invested in January of 2015, put 25K in there.
2015?
2005.
Yeah.
Did sort of, there was a $1 million round at 2.5 per, if I recall. And the company was acquired by AOL within less than 11 months, so at the beginning of December of 2005, and that was a 17x return in 11 months. And it's not so much the return or whatever in the 11 months. It was I actually brought back on that outcome more than the 250K that we had sort of budgeted. And without that deal, and the funny thing is, the only reason why I actually got to invest in that round wasn't because I was an awesome sort of angel investor who could support companies or whatever. It was because my beloved wife worked with the wife of the CTO supporting the lunch program at school. And because they were friends, she told her husband, let Jeff in.
So you owe it all to your wife?
Of course.
That fund did pretty well.
Yep.
From what I understand. And that encouraged you to raise an institutional.
So what happened? So let's sort of fast forward a little bit. So that was in 2005. So there was a bunch of really sort of interesting opportunities which I invested in. And in 2006 there was this piece in Business 2.0 which was called Here Come the Super Angels, or Here Are the Super Angels. And here you had David Hornick, Fred Wilson, you had Reed, you had Josh, and there was 12 guys who were totally legit and me.
Right.
And
right.
it was sort of kind of interesting to be
How
on the
are they
picture.
calling David Hornick or Fred Wilson super angels?
Because
They
it
were
was sort of the
VCs.
guys who were really sort of funding Web 2.0, and for some reason they sort of said, here is the picture of the super angels, and then some of the people were angels and some of the people were actually VCs.
Gotcha.
But for the first time, there was this category of super angels, and there were the angels with bigger wings because we were making more investments and being involved in more sort of opportunities. And when we started to sort of see the transition from business angel to actual VCs by some of us, those funds became the super angel funds, which doesn't mean much, because by definition, if you're managing other people's money, you're no longer an angel.
Yes.
But the first cohort of super angel funds sort of happened at the end of 2006, early 2007. And I was approached at the time by Tim Chang when he was at Norwest, and he said, hey, why don't you raise a fund? And if ever you were raising a fund, we'd be interested in being an LP.
Right.
And to me, the whole angel thing was really working well.
And a VC being an LP, so in a way, that's a VC fund saying, you're playing earlier in the market than we play. We probably don't have the skills or even the desire to play at that level. But if we staked you, then maybe we'd have an inside track on some interesting deals.
That was sort of the strategy.
Did they fund you?
They actually became they offered to be one of the anchor LPs for fund. So Fund 2 was a $15 million fund. We had the discussion with Tim at the end of May of 2007, and I basically raised that fund very, very quickly. We closed the fund in August of 2007. So within a few weeks, literally, the fund was sort of put together.
I can't emphasize this enough for anyone who wasn't around. Raising a $15 million fund was like heresy. It's like, who would raise a $15 million fund? I used to talk to LPs and they would say like, 15 million is my minimum commitment and I can only be 10% of a fund. Like, these guys will never survive.
Which is why I think I was lucky that a VC was one of the anchor LPs, and then a small sort of fund did the rest of the round. And then we brought a few sort of angel investors, friends, to whom I said, I don't know what I'm doing. So, I'm only taking sort of 100K from you guys, because if I lose 100K from you, we'll still be friends, right?
Right.
And
it's good to have friends who can lose 100K, right?
I know, right? No, I was very fortunate.
Yeah.
And so we announced Fund 2 at TechCrunch 40 in September of 2007, and exactly what you described was the reaction. It's like, what the hell is this thing? $15 million funds don't mean anything. This is going to do 60 investments. That was the portfolio construction strategy.
And if I'm not mistaken, that is the TechCrunch that was won by Mint.
Yes, I actually announced the fund with a Mint shirt, which was like, hey, vote for Mint, vote for Mint.
And Mint won, and you paid off Arrington, I guess, so that Mint would win.
We didn't pay off Arrington. Mint won because it was the best product.
I'm just kidding.
And I was an early investor in Mint as well.
Yeah, and so Mint was a great, announced as a $170 million exit, although we both know that wasn't the real price. I don't know why they didn't announce the real price. But that was a great return and quick, and so you were off to the races.
Off to the races. And so, Fund 2 was this sort of experiment which I was running, where there was no real sort of framework or template for a $15 million fund at the time, so I had to make one up. I was very lucky that Josh Koppelman and John Callahan were really sort of close friends, Brad Feld as well. So those three were really my mentors and helped me sort of think through the portfolio construction, the reserves, and so on and so forth. But it was really sort of an experiment. And I ran it for 3 years on my own. So from 2004 to 2010, I invested in 90 companies, 90, on my own.
90.
90, yep, that's a lot. But the premise was, I'm not sure I know what I'm doing, and therefore, if I had to change my mind or whatever, it's easier than change an entire organization. So let's see where this goes. And by the time I had invested Fund 2, and so Fund 2 has Eventbrite, has Fitbit, has SendGrid, has a bunch of really sort of interesting companies, I was clear that there was actually a real micro VC category. And that's when I decided to partner up and bring my partner Charles on board. Then we brought in sort of Stephanie. And so there's 3 of us today at SoftTech, and we raised a much bigger fund, 55. So 3x, Fund 2 obviously compared to our friends in the industry is still micro, but with the premise that we would write larger checks.
And sorry,
and we'd
what
have
year
reserves.
did you raise that?
So that was 2010.
Okay. Now you've mentioned reserves twice, and you and I both know what reserves are, but there's a lot of people who watch the show who don't. So, why don't you just take us through how reserves work in a venture fund and how you think about reserves?
Sure. So typically, a fund will invest at a certain sort of point in the financing history of a company. We invest at seed, which is these days defined as the first institutional check, which can be anywhere from $500,000 to $4 or $5 million. The seed definition has broadened quite a bit. When I started, it was the first, $500,000 to $1 million check. And so you get a certain percentage of ownership with your initial check. And the idea is that over time, the company is going to raise more money at, different sort of valuations. And the idea is that you try and maintain your ownership as much as possible, because if you get 5% of the company when you invest at seed, and then the company raises to make the numbers work, $2 million at 10 posts, so $8 million pre, $10 million post, 20% dilution. If you don't invest more in the company, your 5% is going to become 4% and so on and so forth. So you're going to decrease your ownership over time. And you want to participate with your reserves and deploy them.
And that investment is usually called a pro rata investment.
The pro rata investment.
And so as a fund, you may have, let's make it up, a $100 million fund. And let's say, well, let me call it a $90 million fund. And you're going to invest perhaps $45 million in primary investments. And let's say you have a 3-year pace. So you might do $15 million a year for 3 years.
Yes.
45 million total, and then you reserve 45 million to follow on in your best deals.
Yes.
And so that's primary and reserves, and that's kind of how VC funds are structured.
And the idea is to figure out, how much of your reserves you're going to put in a Series A and then a Series B, and whether the Series C's you still participate, and so on and so forth. And so we've tried different sort of reserve models, and in Fund 4, the most recent, so it's 85 million, and 35 will be used for the initial sort of investments, and then we'll reserve 50. Okay. So almost $1 invested leads to $2 reserved.
Wow, that's big.
Yep. And we need it.
Yeah.
That's the way it works.
So, at some point in time, the market started to shift. A lot of new entrants into the seed category. Some very successful. Some early days. We'll see. And the market itself shifted where it was kind of sleepy when you started, most of it funded around Silicon Valley. The whole market seems to have shifted to San Francisco.
Yes.
I mean, talk about that shift.
Sure. Well, there were a couple of phases. One is there was the New York phase. So remember, like 3-4 years ago, you had a feeling that any sort of flight that you would take from SFO or San Jose to New York would have a bunch of VCs, and all the VCs were looking at opening offices in New York and so on and so forth. And that has sort of stopped. It's dissipated. We're still very active in New York. We assume that 10% of the portfolio will be in New York for any fund, but there isn't sort of the level of activity that we used to see. And then over the past 2, 3, 4 years, we started seeing just an influx of deal flow coming from San Francisco, where a bunch of younger founders were just setting up shop in the city, as opposed to living in the city and commuting down to Palo Alto, Menlo Park, Mountain View, Sunnyvale, Santa Clara, and so on and so forth. And so 2.5 years ago, we started to hang out at Founders Den, which is one of the great co-working spaces in San Francisco, because we need, an office to actually meet those entrepreneurs, because they hate you when you actually have them schlepped down to Palo Alto.
Many of them don't have cars.
They don't have cars, and if you have to go from to Sand Hill from Palo Alto's train station, before Uber, it really sucked.
Yeah.
So we started to spend time in San Francisco, and we spent more time in San Francisco. And finally, we have opened this great office we have now on 2nd and Bryant in the core of Soma. And over the past couple of years, 75% of the investments we've made are in San Francisco.
Wow.
75%.
Complete shift.
Complete shift.
And it seems like a number of funds have either moved to San Francisco or set up offices in San Francisco.
You wouldn't believe how many friends have come to visit me in my office saying, we heard your office is awesome. We're thinking about opening a San Francisco office. Can we come and visit? And so I show them the office. So it's half and half. Half is traditional sort of VC type offices with everyone having their office and conference rooms and everything. And then half is open space where we can reassemble our tables and our chairs to do like an event space, to do a mini seminar, to do a mini conference. And I'm very proud of having 2 wine fridges in the office. Not 1, 2.
Yeah. Does that mean like one is red and one is white, or?
It means that we have plenty of capacity.
It means that you're very French. Because I think in our new office, we're building our offices now, but we have a beer keg because we're Americans. So.
We had discussions around the beer keg lost to the second wine fridge.
As it happens. Why do you suppose there's less emphasis on New York? Is it because San Francisco has just become so active, so why deal with the travel, or it has something fundamentally changed in New York in your experience?
It's interesting. I think that there was a lot of hyperactivity in New York with a lot of really interesting sort of iconic startups, Etsy, Foursquare, sort of Guild, all sort of getting going, and there was this feeling that New York was the next big thing, and I think that up until recently, obviously Tumblr sort of exited at 1.1 billion to Yahoo, but there is a feeling that New York still has to prove itself in terms of an ecosystem that can really groom, a number of startups on a repetitive basis. And so we're happy to look for opportunities there. And my colleague Steph spends, roughly a week every 6 weeks there to meet our portfolio companies. We have about 10 portfolio companies there. So we're very comfortable investing in New York, and we never think about, oh my God, it's a New York company. What do we need to do special because it's in New York? However, we just haven't seen, more than a couple of interesting companies per year for us to invest in, and we never asked ourselves, should we have a New York office?
Right. So the market's changed a lot. We know there's AngelList now, so a lot more people are able to raise through syndicates. There's a lot more angels themselves who just have money from, not just like in the old days it was Google money, but now you have Google money, Facebook money, Twitter money, LinkedIn money. So there's a lot more money going around. What has changed, do you think, in startup land, particularly in the Bay Area? I imagine it's really hard to get talent. I imagine there's wage inflation. I imagine there's office inflation, but more capital available to raise at probably higher prices. There's been the emergence of incubators, Y Combinator, accelerators, whatever they like to be called. How's life changed, and how should founders think about operating now? What words of wisdom would you have?
So I think that, and everything you mentioned is true, and I would say there's even one more sort of change in the ecosystem. It's the emergence of pre-seed funds.
Yeah.
So people would invest before us.
I know, I've heard.
And we'll talk about that as well. So let's just try and summarize. There's an overflow of capital available, and so the supply-demand balance is now imbalance, where there is way more capital than there are ideas. So, and just to put things in perspective, I think there's something like 150 micro VC funds that have raised something like 3.5 billion to invest in the space, to which you will add all the angel activity, angel lists, all the crowdfunding platforms, and so on and so forth. So the issue for entrepreneurs now is not capital. But
the argument that people would make is that capital is now a pure commodity, and therefore shouldn't I just take capital from any source because it's a commodity?
I was getting there.
Yeah.
So,
but I hear that a lot.
Capital is truly a commodity, and you can pretty much source it, from several different, sources, however you sort of want to play it. the old school VCs that you and I sort of represent will say, well, yes, capital is a commodity. We need to bring the commodity, to actually get the company funded and so on and so forth. But at the end of the day, what matters is how strong the syndicate that you're going to be building is and how thoughtful you were in constructing it, bringing people who have this notion of founder market fit. There's also sort of investor market fit. And so if you're building a connected device, if you're building a SaaS company, if you're building a B2B marketplace, go and seek investors that have worked with entrepreneurs in the past in those categories and have built a track record and a reputation for two reasons. One is it's like they will help you sort of put the training wheels on the startup, and they will sort of help you, guide you with true data and ratios and execution sort of examples that they saw in previous companies. But also the fact that those investors are involved in your company and they have the track record of other successes will matter to the next round of financing. Because at the end of the day, there is so much money investing in so many sort of companies that there is sort of a hurdle that changes over time and has changed over time in terms of how hard it is to raise a Series A and a Series B. And you want the right people to help you, guide you, and plot that trajectory of what it takes to raise a Series A and Series B.
What I think people wouldn't appreciate is people like you, and correct me if you think I'm wrong in this, but I view you almost as a shepherd, guiding early stage companies to the A round. And your job is to help them assemble the right team, launch the right product, package the company from a marketing perspective, introduce them to the right A-round investors, and then a slow transition to those A-round investors playing a more active role. And you'll still have a relationship, but then you're on to your next set of seed deals, and then they're with trusted A investors. And so you really occupy that stage of the market, and you want to be the best in that stage, not the best in downstream. How do you do M&A? How do you do an IPO? Is that?
Yep. I think it's. I would add, the day-to-day execution and the strategy that actually gets you to build a big company. Because the challenge we have to overcome to get our companies to raise a Series A, and we've raised something like 25 in the last 12 months. So we've been active in that space. Is a mix of building the right team, building the right product, proving the market opportunity that is actually worthy of a Series A and then a Series B, because as you know, our friends will only sort of invest in something that can be $1 billion outcome or more.
Yeah.
And figuring out the tactics, so the day-to-day, sort of how do you solve problem X, Y, Z, and the strategy of actually what sort of gets you there. But I like the shepherd sort of notion, which we really sort of try and play alongside the rest of the syndicate, and that's why our sort of favorite investments are when the syndicate is kind of to be built, and we can really bring in very, very strong co-investors from our sort of previous companies to figure out who's really good at this type of founder, this type of product, this type of market.
Okay.
And then it's not that we'll give the keys to the Series A guy, but if we do our job right, we'll attract the best possible sort of partner and firm for a given opportunity, and then they will do their thing, and we'll then figure out how to complement them. We might stay on the board for a year or two. We might leave the board after 6 months. It will be sort of discussion with the founders and the new investor. But yeah, we're sort of this factory, this conveyor belt of companies that we sort of take at seed and we bring to A and to B. With
age comes wisdom, which means you and I should be wise.
Yes. And gray hair.
And gray hair. I like to think, Jeff, that if the markets from 2009 to 2014, the tech markets have only gone in one direction.
Yep.
So if the markets only move in one direction, which we know empirically isn't going to be the case, and if your company performs out of the box from day one and you become an overnight success, then probably capital is a commodity, and any amount of success that you're having that's extraordinary, and any amount of market success, if those are correlated for a 6, 7, 8, 9 year period of time, capital is a commodity. But the reality is markets run in 7 to 8 year cycles. Yep. And the reality is even the best companies go through existential crises, or if not quite existential, you know, not picking on anyone, but let's say like Foursquare, where there's been management changes, yep. Etsy, where there's been management changes, and these are still great companies, yep. I hope have great outcomes. But at each stage, I'm sure there were investors helping guide them through yep. that process. So that's like how I see it. Like, what advice do you have for today's? You know, because a lot of people just think, let me just get this round really quickly done on AngelList, I'll be done, and I don't have to talk to investors.
I'm old school, and I will sort of always favor the wise investor will pay attention and really sort of attach his success or her success to mine, mm-hmm. as opposed to the super easy source of capital that doesn't really sort of care about me more than, you know, the 50 or 100 other sort of companies they're investing in. And it's so hard to execute, to become successful, to hire the right people, because, as you said, you know, it's so much more expensive now to find office space in San Francisco, to hire engineers, to hire salespeople, marketing people, to figure out, you know, like capital efficiency is all relative. It's still cheaper than it used to be, but it's 2 or 3x more expensive than it used to be as well, right? So your $2 million round now still buys you, you know, 18 months of runway. Whereas 3-4 years ago, $1 million round would have bought you, right. You know.
So you need to raise more money because it's more expensive. It costs more to build.
And so our answer to that is, you know, we sort of saw this trend, and that's why we raised a larger fund, so that, you know, we actually want to buy 7 to 10% of the companies that mm-hmm. we invest in, mm-hmm. and we never think about the dollar amount per se, because for us, with a large $85 million fund, whether it costs us, you know, $750K or $1 million to get that 10% ownership. Mm-hmm.
I want to talk about, and you'll forgive me for bringing it up, Fab.
Sure.
And I don't want to say bad things about Fab, but I want to see what we can...
But still, you're going to do it?
No, I want to... Look, if I talk about any company that didn't end up a huge success, I could be construed as being negative. My real objective is to learn from it.
Sure, of course.
So you funded originally a gay social networking
yes.
company, and that was called Fabulous.
It was called Fabulous, yeah.
Fabulous. And for a variety of reasons, that didn't work, and they pivoted into Fab, the retailer, e-commerce retailer. Yes. Mm-hmm. That was the darling company for at least 2 years.
For at least 2 years, yeah.
And they attracted a tremendous amount of venture capital. They spent a tremendous amount of venture capital. For the most part, that venture capital's been wasted. They sold the assets, I think, in the end, or sold some of the assets.
So there's a rumor that they're in the process of selling the assets to PCH International, if you believe the press.
If you believe the press. But nonetheless, it doesn't appear like it's going to be $1 billion plus company. What lessons can you draw from that? What lessons should entrepreneurs take away from that?
Yeah, so I think, you know, a couple of thoughts. So we invested in Fab in the first couple of $1 million, and we funded Fabulous. And, you know, they launched the sort of gay social network, and Jason Goldberg, the CEO, decided that, you know, it was good but not great, and they were not, you know, really sort of based on the early numbers and early trends of the business, they were not going to build, you know, the kind of company that he was interested in. And so they talked about, you know, shutting down Fab, returning the money to investors, or they had tried this sort of flash sale mm-hmm. of, I don't remember what kind of item, and just had worked fantastically well. Mm-hmm. And they looked at the numbers, and that was very exciting. And so they went to the board and they said, and we're not on the board, we're just an investor.
And flash sales had been hot for a while. You had Gilt Group,
yep.
Hotlook, Rue La La, a series of
and a bunch of others, you know, and Von Privé.
Von Privé goes back a long way from France.
Yes. And so they said we can either shut down or we can sort of try and launch this flash sales site for everyday design that me and Bradford, Jason and Bradford, mm-hmm. Were very
Bradford was the
co-founder, who has a very keen eye for design. He's mm-hmm. an exceptional sort of designer. And the board said, yeah, you know, we're not in the business of getting our money back or whatever is left of the money back. So let's launch sort of Fab.com. So they shut down Fabulous, relaunch Fab, and the early days of Fab sales were nothing short of absolutely incredible. So they went from 1 to 10 to $100 million in GMV in just a matter of a
and
few
GMV
months.
being gross merchandise value.
Yes. Yeah. And so to power that growth, they raised a bit more sort of money on the note. Then they raised a Series A from Menlo, and then they raised a Series B from Henderson Horowitz at increasing valuations and everything. And the more money they had, the more money they spent. But I think that up until then, there was nothing which was completely crazy. And then for me, the first time that Fab really sort of took a major risk was to go after Casacanda, which was a website, a copycat of Fab that
the Sumner brothers,
had spun out and launched. And basically they were going after Fab, literally copying the website. I don't know whether it was the board, the management team, or both that said, let's go and preempt any effort that the Summer brothers are doing by buying ourselves a German knockoff of Fab and launch it as Fab Europe.
I want to stop and we'll continue on the story, but this is the teachable moment of probably many. But I funded a company in New York called MakeSpace.
Yes.
And we've had great initial success. And the Sumner brothers copied us. Not just them, but there's a copycat in London, there's a copycat in Hong Kong, literally down to stealing our images, laying out the pages the same way. So I sat down with Sam Rosen, and you'll appreciate this, our COO is David Lapter, who was the CFO at Fab.
So he's been there.
Yeah, and a dear friend of mine for many, many years. He was the CFO of my startup. So a dear friend of mine for many years. And Sam said, what do we do? And I said, you do nothing. If we build an amazing company in the US, we earn the right to go international. We earn the right to then go try to take on the copycats. If we take on the copycats and we haven't built a great company in the US, like shame on us. And you really have to stay focused on your core market. And I know markets are global, and I know there are some exceptional people who can do multiple markets at the same time. But it really can be a distraction if you're not multilingual, can't deal with multiple laws, multiple currencies, employment laws, and travel. So,
and talk about sourcing of products, inventory in 2 different places. So I think that for me, the first mistake, and it's easy, hindsight 2020, the first mistake was to go after the copycats and just not do what you just did, which is just focus on the US, focus on building, sort of the sourcing engine, on building the user acquisition engine, and getting the economics right.
And they didn't launch a website and just try to head fake or put a toe in the water. They bought companies.
Yeah.
And so that meant they took on a huge burn rate, and I think that became part of the problem, I guess.
And so, because they were still very successful, they managed to raise yet another round, 150 million if I recall, but the burn rates were just shocking. At some point I said, well, Fab is burning a Series A per month, which actually I heard then made it to a board meeting. And so, I think
these days it's only a Series C per month. So.
I know, right? And so, Jason has made mistakes. The board has made mistakes. I think it's easy to sort of point to people.
I'm not even trying to point fingers, but I will say this. I think they're all related. And what I wanted to peel back the onion on is when you have capital constraints, and this will sound like, when you're a VC, you see the world this way, but I'm not going to fund the overwhelming majority of these companies that watch this video. So I just want people to realize that in a way, capital constraints force focus, they force creativity, and in a way they force innovation, and they force you to ask harder questions about viability of your concept, of your gross margins and other things. Sometimes having too much capital, it papers over the underlying problems of the company, and I really think it was the capital, because everything else to me is a symptom of having too much capital.
Having too much capital and basically trying to grow too fast an infrastructure which wasn't properly sort of laid out, and where the contribution margin was just not a focus whatsoever. And so they were essentially digging their own hole as they were sort of selling more products. And so net, they sort of slowed down. So they raised 335 million or something like that. And as they sort of raised this massive amount, which was still not enough for them to be fully funded, would have needed another 170, 180 or whatever. Jason sort of implemented a cost-cutting. He cut the organization in a third or fourth or whatever, and eventually moved the company's focus towards furniture. And so now we have Hem, which is another website, and it's run from Berlin. And we'll see what happens with Hem, but it's really sort of the next chapter for Fab. And it's really sort of a lesson for entrepreneurs that you could be sort of the darling, in the press and everywhere. But if ever your economics and you just haven't built a real foundation that you can scale on. So scaling too fast, raising money too quickly can be a deadly.
And more problems with overcapitalizing are you set investor expectations, because if they're giving you a huge round, their expectation is that you're going to grow faster, which forces you to try to get the growth maybe more artificially than you otherwise are ready to grow at. When you raise the big rounds and then you do a lot of press, as Fab did, and they started doing TV-based advertising, also part of the problem is you raise the market's expectation. So a normal company that isn't overcapitalized, that isn't as public, probably goes through the same journey where, gosh, our gross margin isn't quite right, or our clients aren't biting here, let's cut back 20% of our staff, let's figure it out. But it's also public when you're that company. And so I think there's a lesson there as well.
Yeah, I think there's the public aspect, but there's also the fact that, you can't sort of buy your way into growth. And if you try and grow too fast before your foundation has been properly laid out, you will eventually sort of pay for it. And, it will sort of crack from all over the place. And I think well-run companies that, continue scaling had to rebuild their infrastructure over time. And there's a lot of, we talk about technical debt, but there might be sort of infrastructure debt as well that you have to pay at some point.
Yeah. Okay, so fast forward, it's 2015.
Yep.
What's changed in 2015? We've now gone through the Fab years, flash sales, e-commerce was a big focus in the market, a lot of capital available. I don't see too many e-commerce companies, too many ad tech companies getting funded these days. What is interesting?
So, yes, we've basically stopped doing anything sort of branded commerce or e-commerce or whatever. We still do marketplaces though. We love the marketplace sort of concept. We're just better at scaling those. It's actually very, very broad if you look at the diversity of things that we see on a daily basis. So we see anywhere from 450 to 750 opportunities a quarter, and we invest in 4. So the challenge for us is to figure out whether this SaaS opportunity and this marketplace and this sort of crazy virtual reality, augmented reality kind of opportunity, which one is sort of the best fit for us. What's new? In terms of, so Bitcoin used to be like super hot, and now I would say, it's less interesting. People are sort of trying to see what the first cohort of Bitcoin investments sort of actually generate in terms of outcomes, and I think it's too early for that. Drones, definitely very hot. Drone infrastructure or actual sort of drone companies.
And do you have any investments in either of those, Bitcoin or drones?
So Bitcoin, we haven't done anything in Bitcoin. We haven't done anything in the blockchain, which is the underlying infrastructure. We're open to blockchain type investments. We just haven't seen something that was a good fit for us. We were inspired by the potential, and we believe that it was actually going to happen, maybe. Drone, we are investors in Drone Deploy, which has the first internet-enabled flight control system for drones, where you can literally fly your drone from your iPhone. And there's an automation aspect where you can just tell the drone where to go, and it will just go on its own.
But to some extent, from what I understand, that's where the FAA is starting to try to crack down a little bit, that they really want to have line of sight to make sure that people aren't putting out drones that aren't sort of controlled in a way.
And it will take years for the market to really materialize. But the good news is we now have a set of regulations where we can fly the damn things, as opposed to having you can't fly drones, period, which was the position up until like a couple of weeks ago. We've looked at virtual reality, augmented reality, artificial intelligence, robots, but we haven't done sort of any sort of investments. And so for us, the portfolio construction that we have is roughly 50% SaaS. So whether it's horizontal infrastructure like an RG-Matrix or SendGrid, vertical SaaS like a Farmaround, which is a SaaS ERP for the farming world. So we actually believe that ag is a great opportunity.
That's a European company, is
it's
it?
Yes, great memory. So it came from Croatia, and it's actually based in the US now.
Okay.
Mobile SaaS, things like Kahuna, which is Marketo for mobile, doing extremely well. So this is sort of 50% of the portfolio. And those are, if you pick the right team with the right product in the right segment, then the blueprint of what it takes to actually raise a Series A is, I wouldn't say it's easy, it's never easy, but it's pretty predictable.
Okay.
Then we do sort of marketplaces, B2C or B2B, very comfortable with that. On the consumer side, we do a lot of devices. So I was seed investor in Fitbit. Then in August, we've done Coin. We've done a couple of really interesting consumer healthcare device. One with you guys at Six Sensor Labs. We're super excited about.
As are we.
Investing with you and investing with Shireen, who's an awesome CEO.
Phenomenal, yeah.
So we've
just say real quickly what that company does.
So Six Sensor Labs is a food allergen detector. So it's a company which has two interesting challenges. One is mechanical engineering and figuring out the device size and shape that will allow you to hold a vial which has which contains an antibody that will detect gluten, lactose, and eventually peanuts or nuts at a 1 part per million sort of dose.
I think it's 20 parts per million.
They want to go to 1 part per million.
Really?
Yes.
Okay.
So, and the idea is, you're eating, you want to see whether there is gluten in something, you sort of use the vial and sort of crunch a little bit of the food, shake it, put it in the device within 2 minutes.
Yeah, and what maybe people don't realize is I think it's about 3 million people in the U.S. have celiac disease. Yes. I happen to have had an aunt with celiac disease, and they can't have any gluten.
Yep.
And then if you add gluten intolerance, if you add people who want to have low gluten lifestyles, obviously it expands the market greatly.
Yeah. And it's really a razor blade model where every vial will be something that you purchase. So very excited about the opportunity. And we stay away from the FDA. So both Halo Neuroscience and Six Sensor Labs won't be sort of FDA subject to FDA approval. And so it's up to us to really release the product, market it, and off we go. So we'll do a few of those in the consumer sort of space. Actually, consumer healthcare is one of the big wedges for us in Fund 4. We believe that finally this $4 trillion spending in 2015 will be an opportunity to build interesting startups. We haven't done anything on the B2B side, but we're really excited about the B2C side. We'll do a bit of...
4 trillion is probably an exaggerated number, right? Because
no, it's actually...
What's included in 4 trillion? It must include doctor spend.
It's the overall spending in healthcare in the US in 2015 will be $4 trillion this year. I gave a
I don't doubt that.
The web,
I don't doubt that, but that's not really a total addressable market, right? Because
it's a total spend. Okay. So overall, if you look
at... A subsegment of that is still a very large number.
It's just a gigantic market opportunity, and I think that sensors and the ability to communicate with your sort of doctors and to have on-demand services like Uber for psychiatrists, we have that one, it's called Lantern, is actually, it's real, and it might take a few years to really sort of materialize as a mass market opportunity, but we believe that building those companies now is a real
and what about, like, obviously you were in Fitbit, so the market innovator in hardware for
wellness and trackers.
And now that market just seems, from watches to health trackers to everything else, seems so saturated. A, are you still looking in that category, and what would be a standout? Like, how would you even decide? And B, how should founders feel about entering that market? Should they go into a market that's going to have so many dollars and so much competition?
So, because we're in Fitbit, which is the market leader, NPD data over Christmas or Q1 sort of showed that for 4 trackers sold in the US, 3 were Fitbits. So it's sort of game over from that standpoint. I wouldn't sort of advise people to sort of go and compete with them directly because they have so much sort of market power and pull that it's very difficult.
Let's just say even Nike failed.
Even Nike failed, and it's not. They tried. They spent a lot of money on marketing and product development, but it just failed and decided to pull out because they were only 8% of the market. So 75% is Fitbit, 8% was Nike. However, I think that lifestyle, exercise, wellness, and the ability to figure out what is the next sort of level of interaction with your doctors and a community of people sort of helping you, support you. Mental health is a sort of genuine issue in the US, and there's very little which is being done in that space. So I think there's a bunch of white spaces that you can find in consumer healthcare, which we're very excited about, and we're actually looking actively to invest in.
Don't you think mental health is an area that VC should pay more attention to in terms of our entrepreneurs and our investment? I feel like if there's a criticism I have of our industry is we focus all on the raw technical prowess and power of teams and not enough on well-being of mental state of entrepreneurs.
Yep, I agree.
mean, it's a very stressful industry with a lot of highly volatile people in highly volatile situations and founder fighting and stuff like that. It feels like we as an industry are not as good as we could be there.
Well, I think that sort of comes back a little bit to what I was talking about in terms of value add and people who care, and because that's what you and I do as well. It's we take those calls at 11 p.m. at night or 6 a.m. in the morning or whatever, and people don't feel super well because there's a problem and they're not sure that the fundraising is gonna happen. They might sort of actually blow up or whatever, and so there's a lot of I talked about twinning wheels, but also making sure that the team is actually able to go through those challenges as unarmed as possible.
And that's the thing that's really not talked about, Jeff, because no one writes blog posts on, I always say this, on founders fighting or on founder depression or on founder problems with alcohol or Adderall or whatever other problems they have. And yet it's very real and we deal with it on a regular basis. I see it even more problematic after your A round and your B round because now you're at company sizes that could be 60, 80, 100 people. And we're seeing some of this emerge with sexism charges or sexual harassment charges or,
We're right in the middle of the Clavier Perkins lawsuit right now.
Yeah, and I didn't want to go there so much from a VC standpoint, but we see it inside of companies. There's been some high-profile cases. I think one was GitHub had some issues. I know Tinder had some issues. But I guess I'm just saying, at that level, personal coaching, 360 reviews, getting founders' feedback on how they're doing, exposing that team dynamic. Because you think about it, if you coach the LA Clippers, you're going to focus on the psychology as much as you're going to focus on the physical health, and our industry doesn't seem to do that.
I think it's the personal check-in and the how are you doing that is important, which is why I really try to spend face-to-face time with my founders to sort of see how they're doing as opposed to just catching up on the phone or whatever, because there are things and you need to pay attention to those things as well. And obviously when your company is sort of growing well and I say, what are the issues that keep you up at night or whatever, you try and then figure out whether there is something personal there. But the problem is you need to pay attention, and it's not always easy to pay attention when you have the time pressure that we have with so many things that we have to do every single day.
Gotcha. Listen, Jeff, we could go all night, but it's been a wonderful opportunity to spend time with you hearing about SoftTech VC. Huge congratulations on new fund, on 10 years, on great returns, on San Francisco office, and I would love to reconvene in a year.
I would love to do that, and let's catch up. Yeah.
Let's do a check back and see how the market's evolved.
Good to see you.
Spending time with you.
Thank you.